Welcome to the fourth lecture of this 2024 mentorship series. Now that you understand how to access and look at each individual candlestick, I wanted to give a brief overview of what the financial markets are. This way you have a general idea of what it is that you are getting yourself involved with, and with this in mind, if trading is a business, you'd want to get to know the product you're trading, right? The financial markets refer to the various platforms, systems, or networks where individuals, institutions, and entities engage in buying and selling of financial assets. These assets can include stocks, bonds, currencies, commodities, derivatives, and other instruments. The financial markets serve as a mechanism for the allocation of capital, price discovery, risk management, and facilitate the transfer of funds between savers and borrowers. In essence, financial markets provide a marketplace where participants can trade financial instruments, determine their values, and access capital. The transactions in these markets are driven by the forces of supply and demand, and prices are influenced by various factors such as economic conditions, geopolitical events, and market sentiment. Financial markets can take various forms, including stock markets, bond markets, foreign exchange markets, also known as Forex, commodity markets, derivatives markets, and more. These markets play a vital role in the global economy by enabling efficient capital allocation and fostering economic growth. They also provide opportunities for individuals and institutions to invest, manage risk, and participate in economic activities. The purpose of financial markets has many levels to it, encompassing several crucial functions that contribute to the efficient functioning of the economy. Here are some key purposes of financial markets that I know of in no particular order. First is capital allocation. The function of capital allocation is that financial markets facilitate the flow of funds from savers to entities in need of capital, such as businesses, governments, and individuals. The significance of this process allows businesses to raise capital for expansion, research, and development, fostering economic growth once again. Second is price discovery. The function of price discovery is that financial markets determine the fair market value of financial assets through the interaction of supply and demand. The significance of accurate price discovery ensures that assets are valued appropriately, reflecting their perceived worth in the marketplace. Third is liquidity provision. The function of liquidity provision is that financial markets provide a platform for buying and selling financial instruments, ensuring liquidity by allowing participants to easily convert assets into cash. The significance of liquidity provision is that liquidity enhances market efficiency and flexibility, allowing investors to enter or exit positions without significant price impact. Fourth is risk management. The function of risk management is that financial markets offer a range of instruments, such as derivatives, that allow participants to manage and hedge against various types of financial risks. The significance of flexible risk management the financial markets provide is that effective risk management helps mitigate uncertainties, promoting stability and confidence in financial transactions. Fifth is facilitating investment. The function of facilitating investment is that financial markets provide opportunities for individuals and institutions to invest their surplus funds in a variety of assets. The significance of this is that investments offer potential returns, enabling savers to grow their wealth over time and fund future financial goals. In our case, this mentorship will teach you how to analyze price and invest based on the analysis, whether it be short-term or long-term. Sixth is intermediation. The function of intermediation is that financial intermediaries, such as banks and investment firms, play a role in connecting savers with borrowers, channeling funds towards productive investments. The significance of intermediation is that intermediation enhances the efficiency of capital allocation and reduces information asymmetry between borrowers and lenders. Seventh is currency exchange. The function of currency exchange is that foreign exchange markets facilitate the trading of currencies, enabling businesses and investors to engage in international trade and investment. The significance of this is that currency exchange is essential for global commerce, allowing participants to conduct transactions in different currencies. Eighth is facilitating economic growth. The function of facilitating economic growth is by providing access to capital, managing risks, promoting investment, and in turn, financial markets contribute to overall economic growth. The significance of this is that a healthy financial system supports job creation, innovation, and the development of infrastructure. Ninth is income generation. The function of income generation is that financial markets offer opportunities for individuals to generate income through dividends, interest payments, and capital gains. This is significant as income generation encourages saving and investment, contributing to personal financial well-being. And in 10th is wealth redistribution. The function of wealth redistribution is that financial markets allow for the redistribution of wealth by providing opportunities for individuals to accumulate wealth through investments. This is significant as wealth redistribution can contribute to reducing income inequality over time. Once again, this is a brief overview of some purposes of the market. If this interested you, I encourage you to dive deeper in your own time, although this knowledge is not necessary to succeed as an intraday trader. In a nutshell, financial markets play a central role in the efficient functioning of the economy by allocating capital, determining asset values, managing risk, and fostering economic growth. Some of the major financial markets include the stock market, bond market, foreign exchange market, commodity market, derivatives market, money market, real estate market, cryptocurrency market, options market, and futures market. What we will focus on in this mentorship is the futures market, but once again, a brief overview of everything else so you have a general idea. First is the stock market, aka equities market. As we get more in depth with our technical analysis, the equities open will be referred to, and now you know what it means. The stock market is where shares or ownership stakes in publicly traded companies are bought and sold. Investors buy stocks with the expectation of capital appreciation and dividends. Second is the bond market, aka debt market. The bond market is a marketplace for buying and selling debt securities, representing loans made by investors to governments, municipalities, or corporations. Investors purchase bonds earning periodic interest payments and the return of principal at maturity. Third is the foreign exchange market, or aka Forex. This is the global marketplace for trading currencies. Participants trade one currency for another, aiming to profit from exchange rate fluctuations. Fourth is the commodity market. This is a platform for buying and selling physical commodities, such as gold and oil, or commodity futures contracts. Participants include producers, consumers, and speculators seeking to hedge or profit from commodity price movements. Fifth is the derivatives market. This is a marketplace for financial instruments derived from an underlying asset, including options and futures contracts. Derivatives derive their value from the price movements of an underlying asset and in turn are used for hedging and speculation. Sixth is the money market. The money market is a short-term debt market for high liquid and low risk instruments. Instruments including treasury bills, commercial paper, and certificates of deposit. These are used for short-term financing and liquidity management. Seventh is something that is more common knowledge, the real estate market. This would be a platform for buying and selling real estate properties. Participants include home buyers, real estate developers, and investors. Prices are influenced by factors like location, demand, and economic conditions. Eighth is the cryptocurrency market. This market is strictly digital, to my knowledge, and is an asset market for buying and selling cryptocurrencies such as Bitcoin and Ethereum. Blockchain technology underlies cryptocurrencies, providing decentralized and secure transactions. Ninth is the options market. This is a platform for trading options contracts, giving the holder the right, but not the obligation, to buy or sell an underlying asset. Why some may choose options over the other markets is because options provide flexibility in risk management and speculations. Last but not least is the futures market, which is what I personally trade and will be teaching around in this mentorship. This is a marketplace for trading futures contracts, which are agreements to buy or sell an asset at a predetermined future date and price. Futures are mainly used for hedging and speculation. The futures market consists of standardized contracts with set expiration dates. These markets collectively form the backbone of the global financial system, offering participants a wide range of investment vehicles and risk management opportunities. Each type of market serves specific purposes and caters to different financial instruments and assets. Having a general understanding of the different types of financial markets is important so that as we progress in this mentorship, we will know how to do intermarket analysis. Participants in financial markets can be broadly categorized into various groups, each with distinct objectives and roles. Here are some of the key participants in the financial markets that I know of, and in no particular order. First are individual investors. These are individuals who invest their personal funds in financial instruments. They may seek capital appreciation, dividends, or interest income from their investments. Their goals often include saving for retirement, education, or other financial objectives. Second are institutional investors. Institutional investors are large organizations managing substantial amounts of capital on behalf of others. Institutional investors include entities such as pension funds, mutual funds, hedge funds, insurance companies, and endowments. Their primary objective is to manage and grow the asset entrusted to them. Institutional investors often have a long-term investment horizon and aim to achieve stable returns for their beneficiaries. Third are banks. Banks play a multifactored role in the financial markets. They participate in lending and borrowing, providing liquidity, and engaging in trading activities. Banks aim to generate profits through interest, fees, and trading gains. Additionally, they facilitate economic activities by offering financial services to individuals and businesses. Fourth are companies. Companies enter financial markets to raise capital for various purposes, such as expansion, research and development, and debt repayment. Publicly traded companies issue stocks and bonds, allowing them to access funds from a broad investor base. Their objective is often to optimize their capital structure and support business growth. Fifth is the government. Governments participate in financial markets to raise funds for public projects, infrastructure development, or budgetary requirements. They issue government bonds as a means of borrowing money from the public and institutional investors. Governments aim to manage their fiscal policies effectively and ensure economic stability. Sixth is us, traders. As traders, we engage in financial markets with the primary goal of making short-term profits through buying and selling financial instruments. We may use various strategies, including technical analysis, fundamental analysis, and algorithmic trading. We aim to capitalize on market inefficiencies and price movements. Seventh is who we are trying to profit alongside of, which are the market makers. Market makers are financial institutions or individuals that facilitate the buying and selling of financial instruments by providing liquidity. Their objective is to profit from the bid-ask spread and ensure smooth market functioning. Market makers play a crucial role in maintaining market liquidity. Eighth are regulators. Regulatory bodies such as the Securities and Exchange Commission, also known as the SEC in the United States, have the objective of ensuring fair and transparent markets. They establish and enforce rules and regulations to protect investors, maintaining market integrity and prevent fraudulent activities. Ninth are financial advisors. Financial advisors provide advice and guidance to individuals and institutions regarding investment decisions. Their objective is to help clients achieve their financial goals while considering risk tolerance, investment horizon, and market conditions. And lastly, we have the other entity that we try to profit alongside as traders, central banks. Central banks, like the Federal Reserve in the United States, participate in financial markets to implement monetary policy. They may engage in open market operations, buying or selling financial assets, to influence interest rates and money supply, aiming to achieve economic stability and full employment. Each participant in financial markets contributes to the overall functioning and dynamics of these markets, driven by their specific objectives and roles. The interaction of these participants create a complex and interconnected financial ecosystem. Market regulation refers to the set of rules, policies, and oversight mechanisms put in place by regulatory authorities to ensure fair, transparent, and efficient functioning of financial markets. The primary goals of the market regulation are to protect investors, maintain market integrity, and foster confidence in the financial system. Here are key aspects of market regulation in no particular order. Regulatory authorities, often government agencies, are responsible for overseeing specific financial markets. Examples include the Securities and Exchange Commission, or known as the SEC in the United States, the Financial Conduct Authority, FCA, in United Kingdom, and European Securities and Markets Authority, also known as the ESMA, in the European Union. For licensing and registration, financial market participants such as brokers, investment advisors, and exchanges are typically required to obtain license and registrations from regulatory authorities. This ensures that qualified and reputable entities operate in the market. With this in mind, I am not a licensed financial advisor, so once again, everything in this mentorship is taught based on my knowledge and accomplishments. For disclosure requirements, companies issuing securities in public markets must adhere to strict disclosure requirements. This includes providing accurate and timely information about their financial health, operations, and other material events. Investors rely on this information for more informed decision making. For market surveillance, regulatory authorities employ surveillance tools to monitor trading activities and detect market manipulation, insider trading, and other forms of misconduct. Advanced technologies and algorithms help identify irregularities in trading patterns. For the enforcement of rules, regulatory bodies have the authority to enforce compliance with market rules and regulations. This may involve imposing fines, sanctions, or taking legal action against individuals or entities that violate market rules. This is why there was the recent case of the CFTC taking action against MyForex Funds, which is a prop firm. So if you guys would like, you can look into that as well. For market integrity, regulations are designed to maintain the integrity of financial markets by preventing fraudulent activities, ensuring fair competition, and safeguarding against market abuse. This contributes to the overall trustworthiness of the financial system. For investor protection, regulatory frameworks aim to protect investors by establishing rules for fair treatment, transparency, and disclosure. This includes measures to prevent conflicts of interest and ensure that investors have access to essential information. For market access and fair competition, regulations often promote fair competition and equal access to financial markets. This includes measures to prevent monopolistic practices and ensure that all market participants have a level playing field. And the list goes on. Once again, if this interests you, feel free to dive deeper in your own time, but personally, I don't think that this is required knowledge for the success of an intraday trader. Market dynamics refer to the factors that influence the behavior of financial markets, shaping the movement of prices, trading volumes, and overall market activity. Understanding market dynamics is crucial for participants, including investors and us, traders, as it helps us make informed decisions and navigate the complexities of financial markets. Here are some key aspects of market dynamics in no particular order. These factors will be covered in later lectures as well, but this is a general overview of what I pay most attention to. The basic principle of market dynamics is the interplay between supply and demand. When demand for a financial asset exceeds its supply, price tends to rise and vice versa. As I trade based on ICT's algorithmic theory, I still believe that supply and demand moves the markets, but by algorithms rather than retail intervention. As mentioned earlier, market participants can collectively come together and influence the market's behavior based on their actions. For market sentiment, the collective mood or sentiment of market participants can significantly impact market dynamics. Positive sentiment may drive buying activity, while negative sentiment can lead to selling. I mainly see this in individual stocks or cryptocurrencies. Central bank decisions on interest rates can affect borrowing costs, investment decisions, and the attractiveness of different assets, influencing market dynamics. This is why we don't trade FOMC, for example, as it invokes large range volatility in the markets. But once again, this will be covered in a later lecture. For liquidity, the ease with which assets can be bought or sold in the market defines liquidity. Higher liquidity generally leads to smoother market dynamics, while lower liquidity can result in price gaps and increased volatility. For market trends, the identification and recognition of market trends, whether upward, which is bullish, or downward, which is bearish, play a crucial role in market dynamics. Trend following strategies are often based on these dynamics. With institutional order flow, there are a lot of parts that come together and create it. So this will be a large part of this mentorship, and I'm just going to leave it here, but just know it will be covered later on in this mentorship. As traders, we utilize technical analysis to study historical price charts and patterns to predict future market dynamics. Chart patterns and indicators are employed to identify potential trends and reversals. For news and information, real-time news such as financial reports and information dissemination impact market dynamics. Market reactions to news can be swift, causing sudden shifts in sentiment and prices. This is why we avoid news events such as FOMC, NFP, CPI, and PPI due to these volatile market reactions. For regulatory changes in the market regulations and policies can have a profound impact on market dynamics, affecting trading practices, market structure, and investor behavior. Last, but definitely not least, are black swan events. These would be unpredictable and rare events known as black swan events. These events can disrupt market dynamics unexpectedly, leading to the extreme volatility and market reactions. As we progress into the mentorship, we can learn to anticipate when these could occur and how we can capitalize on them as intraday traders. Understanding these dynamics requires a comprehensive analysis of multiple factors and continuous monitoring of market conditions. As traders and investors, we employ a variety of strategies, both fundamental and technical, to navigate and respond to evolving market dynamics. Diversification is a fundamental principle in investment strategy that involves spreading investments across different asset classes, industries, geographic regions, and individual securities to reduce risk and enhance the potential for returns. The importance of diversification stems from several key factors. Here are some of those factors, and once again, these are listed in no particular order. Diversification helps mitigate the impact of poor performing assets on an overall portfolio. Different assets may react differently to economic events or market conditions, reducing the risk of significant losses. Different assets have varied performance patterns. When one asset is underperforming, others may be performing well. This stability in performance helps smooth out the overall portfolio returns. For asset class diversification, allocating investments across various asset classes, such as stocks, bonds, and commodities, provides exposure to different market segments. Each asset class reacts differently to economic cycles, helping balance overall portfolio performance. For industry and sector diversification, diversifying within an asset class by investing in different industries and sectors reduces vulnerability to adverse events affecting specific sectors. A downturn in one industry may be offset by growth in another. For geographic diversification, spreading investments across different regions or countries helps protect against regional economic downturns or geopolitical risks. It also allows investors to benefit from global economic growth. For idiosyncratic risk, or the risk specific to an individual security, can be minimized by holding a diverse portfolio. The impact of a poor performing individual stock is less significant when it forms a smaller part of a broader portfolio. Diversification aims to achieve the optimal balance between risk and return. By combining assets with varying risk profiles, investors can potentially achieve higher returns for a given level of risk, or the same returns with reduced risk. And lastly is long-term consistency. Diversification is especially crucial for long-term investors. Over time, market conditions change and certain assets or sectors that outperformed in one period may underperform in another. Diversification provides a strategy for consistent returns over the long term. In summary, diversification is a risk management strategy that aims to optimize portfolio returns while minimizing the impact of adverse events. It is a foundational principle for building resilient and balanced investment portfolios tailored to individual risk tolerance and financial goals. As intraday traders, this wouldn't affect us as much as we get in and out of markets within the same day. But as we learn technical analysis techniques in the coming lectures, they are applicable to all time frames and all asset classes, meaning that as we scale our capital up, in the long run, we would begin to invest long term as well, which is where diversification comes into play. That's all for this lecture, and I hope you found it insightful as to how the financial markets operate. Once again, there is a lot more to this, so feel free to dive deeper in your own time if you'd like to. The homework for this lecture will be posted in the description below. Don't cheat yourself of this learning opportunity. Study and do the work honestly, and I promise your hard work will be rewarded. See you in the next one, and as always, have a great day.